We've got an hour now to talk about something I guess that's on most of our minds, riskless return or returnless risk. For the panel we've got here, fantastic array of investors from a wide range of different backgrounds. We've got Mark to my right. He's head of product research and innovation, perhaps the coolest title of the panel at S&P Risk Services. We've got Roger, he's CIO of University's superannuation scheme. We've got Bob at the end, who's global strategist of Schenkman Capital, and Marino, who's head of multi-asset at Barings. I thought with this panel we'd spend around 20 minutes talking through some of the bigger issues out there. About 20 minutes where I'll ask everyone the same questions. We'll do 30-second rounds, short and sharp, and then leave at least 15, but hopefully 20 minutes for questions from yourselves. So maybe to start off, despite the rally, or rather sell-off that we've seen in rates since the Trump election and immediately before, we've still got 33% of developed market bonds which offer negative yields. So I guess in the current environment with potential changes coming out of the US, are we looking at the secular stagnation camp continuing to be doomed and global rates continuing to sell off? Maybe we can start with you, Marina.
Great. So in fixed income, we have a situation where the net flows into US Treasuries were already negative before Trump. Institutional investors around the world, particularly central bank managers and reserve managers, were taking money away. Think about emerging markets, think about the need for cash in those economies. So that's number one. The only one remaining buying this asset class were people with bond-like liabilities or people managing portfolios against indices. On the other side, however you look at it, the prospective return over the long run for something like the 10-year US Treasury has been between probably 1% and 2% now for a long time. You know, in the fixed income world, you say that the total return that you're going to get from a bond is always very similar to the yield that you are buying. And the third thing that I would say is that we have already been in a transition phase between monetary policy and fiscal policy, and that fiscal policy is going to be debt financed. So these three elements were already in place before Trump, and I think that Trump has only ignited this crisis of confidence. Now, what is going to happen next? Well, I think that probably we're going to have another leg of weakness in 10-year Treasury notes. I think we're going to go up to about 270, 275, and at that point what you'll see is that the steepness of the curve will make the 5-year forward and the 10-year forward as high as 3.25, 3.5. That, in my view, is going to be a terrific moment to pick up some government bonds around those levels.
Bob, same question to you. Is the secular stagnation camp dead now that Trump's been elected? And are we doomed if we're buying negative yielding bonds to losses?
Well, I think a lot of Marino's points are very valid for the government market and the sovereign market. I think it's very different when you go down the credit spectrum and actually get into credit. Because what we are seeing with these policies, assuming they're successful and they go through and everything, is an expectation of greater growth. And I think in Europe as well, where we are in the cycle, we're starting to see a little bit better and a little bit more widespread growth. And what we often see in these cycles is even though rates are going up, when you're seeing credit improvements in the credit side of the market, you can actually get very good performance by credit improvements and credit gains. I very much agree with Marina. I think it was a really interesting point. I think we may go back and look at this Trump event, if you will, as kind of a changing point in how investors are viewing the market. We've had 7 years of focusing on the central bank actions and probably an overly activist central bank, and now we may be entering a period of overly active government actions, and this may really have to change how investors view the market because some of that central bank put may be going away, and government actions tend to be a lot more specific. So I think you have to be very careful in how you construct your portfolios in a cycle where there's government actions affecting the market more than central bank actions affecting the market.
Roger, maybe pick up on that. I mean, have central banks run out of steam, and can markets more broadly survive it if they have?
Yeah, I think central banks have run out of steam. I mean, things have happened in the last sort of 5 years that we probably didn't imagine could or would happen. And there does come a point in which there are sort of dysfunctionalities introduced, maybe a lot of them, and the marginal benefit is very slight for continuing in that direction. So yeah, I don't think that there is great room for central banks to come up with yet another innovation, or indeed need to do so at this point. So the central banks are having the challenge of how do we get out of this? It's not obvious how the European Central Bank is going to turn off the tap, and they're quite concerned about that. But I think the movement towards higher yields is probably going to have a fundamental basis, and some of the policies of today will look very silly, I suspect. I mean, Japan, we should realize, has said it is going to stand against the tide. It is going to keep that 10-year yield at zero. Whatever's happening elsewhere, imagine sort of US Treasury yields are 4% or something like that, and Japan's still trying to hold the line on they'll have bought every JGB in issue. So I think the central banks have tried really, really hard, and it is time for them to back off.
Some of those comments actually sounded outright bullish. Yields going higher because of fundamental reasons, not being clear whether further central bank action is needed, and regime shift. Mark, do you agree?
Well, I think you have to look at this a little bit with a global view, right? You were talking about the US, you're talking about Europe, you're talking about China, you're talking about Japan. What you had the last few years was everywhere you looked, you had low rates, right? Now you're looking at the US economy. GDP Q3 growth was 3.2%, unemployment's 4.6%, payrolls up, right? You're looking at a pretty good economic fundamental picture. You're looking at Europe, not so sure. You're looking at China, you've got an overhang of debt. You're looking at high level of debt, more poor quality debt. So I don't know where that leaves you. Right, GDP growth, I think our economists still are looking at 6.6% growth this year, 6.4% next year. Well, that's not so bad, right? I mean, 6.4%, it's not bad. Maybe it's less than 8% it used to be, but I'll take 6.4%. So I think you have to look at the fundamentals of each of the regions you're talking to. I don't think we can look at this today with a single lens, because everybody is going to start looking different. You're going to start seeing divergence, which, by the way, to me means opportunities.
Well, it is getting bullish. This is meant to be about the risks. Let's pull it back down. Europe, lots of political events next year. Equally, though, we've gone through a range of political events this year which were not predicted by the experts, both in terms of the outcomes and also the implications subsequently for asset prices. So, Bob, maybe to you, should we be concerned about the litany of political events next year in Europe?
Well, I guess if the overnight trade on the Trump election and the Brexit, you should be concerned for about 48 hours, I guess, and then everything is fine again. But yeah, I think we should be concerned because, as I said, political changes and political actions really can affect markets. And obviously, we don't know which way the elections are going to go here, but there seems to be a move, certainly a populist move around the globe, and it's going to change things. And if we see more elections like that, it's going to change things, and it will probably cause more differentiation and more focus required on individual sectors and individual names rather than, some of the macro trade. And I think some of it is a political cycle. Just like we see business cycles and credit cycles, or at least we used to, we have political cycles. And I think in Europe especially, and to some extent in the US, there's been this political cycle moving toward one size fits all more, where policies are coming from Brussels and trying to adapt to a very different, markets that are very different. I mean, all you have to do is, order potatoes up in Brussels and order potatoes in southern Italy, and you know that there's a massive difference in this continent. And they're trying to fit one type of policy to it. And I think now we're going through a cycle where people realize they need different policies for different parts of Europe. And that, I think, is what's driving some of this political change. And it's going to change markets as well.
There's a fantastic quote on Bloomberg Gadfly yesterday. It took the market 3 days to shrug off Brexit, 3 hours to shrug off Trump, and 3 minutes to shrug off the Italian referendum. Bull market indeed. Sorry, getting back to the risks. Roger, political risks next year. If you had to pinpoint one, is it the German election? Is it the Dutch? election? Is it the French election? Is it something else?
Well, there's probably somewhere that we aren't even anticipating it, but the French election could be the more disruptive. I think it's right at the heart of Europe. I don't think Marine Le Pen is going to win, but then I didn't think that Trump would win, and I didn't think that Brexit would win. So that's my forecasting record on politics. I think Germany will probably still have a sort of central coalition that will hang in there, and that is ultimately the most important foundation stone for the European Union. But France is the one where the risks, in the sense of the probability of an anti-European lurch, is greatest.
I have a couple more sort of meta questions before we get into specific investment tips and things to avoid, things to buy. Marina, maybe kind of a question to you. The typical 60-40 portfolio that for much of our careers made a lot of sense becomes more problematic when you have positive correlation between bonds and equities over time, and when you have so much of the riskless asset actually costing you to hold it. I mean, does the 60-40 portfolio diversification or diversified portfolio really make sense in the current environment?
Don't get me started with the 60-40 because it's one of my favorite topics.
Yeah, I know.
60-40 had a tremendous return in the last 30 years. I always say that if you go back to the time I started in the financial markets in 1988, if you would have invested in a naive portfolio, 60-40, 60 equities, 40 bonds, in the US you would have got a return of about 10% per annum, with a standard deviation of about 9 and an information ratio above 1. Moreover, the correlation between bonds and equities helped you during periods of stress, and we have gone through many periods of stress during the last 30 years. So this has been the best thing to hold. Things are going to be different. We experienced a series of incredibly positive factors. We had globalization, we had the fall of the Berlin Wall, we had monetary policy, we had defeat inflation. So a lot of things have led equities to new highs and bonds to new highs. Now, what is coming next? Bonds haven't got the possibility to diversify a portfolio anymore, given the yields they're at. There will come a time where they are going to be useful again, probably not now. And the second reason is that probably the next crisis is going to be originating from the fixed income market, maybe from an excessive rise in yields. So that is not going to help. So what can help? I mean, there are two things which obviously we've got in front of us, actually three. The first one is gold, but we know that gold during a period of Fed tightening doesn't really work too well. The second one is currencies, and there we have to cross our fingers and hope that the yen continues to be negatively correlated to risky assets. And the third thing, which is another thing which is very close to my heart, is private assets. Now, I think a lot of people in this room, if you are asset allocators, as I am, should look at private assets, a larger allocation to private assets, and I'm talking private equity, I'm going to talk about asset-based investing, private debt, because in the current environment, there will be some help provided by those assets, and also a much better set of returns. I think one of the themes we have in front of us is very poor returns from public equities, public debt, and listed assets, and on the other side, interesting returns and interesting features from the private asset side.
Can I maybe push you on that though, because so much money's gone into the private markets, from people being pushed up the risk curve. You've got arguably unnatural kind of owners of those assets already. Valuations are very high. Why are you so sure that private markets are going to get a better risk-adjusted return over an extended period of time?
Well, if you have a look at the public markets and listed assets, we do 10-year work on 10-year expected returns and risk, and the best information ratio we can get from public assets is probably 0.3, 0.4. There is nothing which we believe will deliver more. in a world of static betas. Obviously, you have to complement that with active alpha. But on the private side, two things in particular. I mean, private debt has a lot of very interesting features. You can get 8% senior secured loan with a good equity cushion below. You don't need an exit, and you don't even need leverage because you're already getting 7 to 8%. Now, not everybody can do that because a lot of the asset allocation portfolios have got some sort of liquidity requirement. So I'm actually taking the opposite side. I think there are too many long-term investors which pay too much for liquidity and should be doing more in private asset classes.
So Mark, same question to you. Is traditional diversification dead? Is Marino right or wrong that the only answer seems to be private markets, or is there some other way as head of innovation that you're innovating for your clients?
So as much as I love innovation, I'm also skeptical of a lot of things that's going out there. Then one of the previous panels talked about artificial intelligence and machine learning, all those magical things. It's been untested. It is still untested. So if you're managing money and you're thinking that you're going to get this amazing return with this newfangled thing, just be careful. It doesn't mean that you're not going to get it, but be careful. So is it going to help? Absolutely. One of the ways you can look at it, there's direct lending, right? We don't do anything directly into direct lending, but it is a theme. If you can get 7, 8%, and you're taking a U.S. consumer risk, are you okay with that? Maybe, maybe not. That's really up for you to decide. So I'd say, you know what? Why is traditional dead? I'm always a little fearful about going, to the other extreme. I think to Bob's delight, I will say that, leveraged loans are not a bad place to be, right? Floating rate, good yield, high in the capital structure. Why wouldn't, and they're, well, compared to private debt and private equity, they're reasonably liquid. They're not liquid compared to, U.S. Treasuries. So you have to make that, you have to have a balance. And I think if you look at the portfolio, what's your time horizon? If your time horizon is 10 years and you can take some of that liquidity premium, absolutely do it.
Simon, if I could jump in,
Please.
I think, I'm not an asset allocator outside of, credit. And I certainly think there's places for private investments, private assets, and private debt. And a lot of the levered debt market is sort of like pseudo-private debt. But I do think you have to be careful how you compare the two, because whether it's, forest lands that you're buying or whether it's direct lending, you're not marking to market. So you don't really have a volatility measure. And not saying that those are bad investments for part of the portfolio, but you have to be very careful about comparing volatility and risk in something where you can get a market in every day versus something where you don't have a market in every day. And it's just a different type of measurement of risk. Same with the liquidity premium. I mean, the ways you've been able to add value in this market is adding duration or adding credit risk or adding illiquidity. And we haven't fully tested how all of these are going to unwind. But it's just the markets are very different and have different roles in the portfolio.
Roger, 5% return, is it possible to get from a cross-asset portfolio, 5% annualized return over the next 5 years? And if so, how much riskier would that portfolio be than it has been historically?
Okay, so our asset allocation at the moment, if you boiled it right down to a kind of a liquid portfolio, wouldn't be far off your 60-40. It's actually, the portfolio is very differently invested. It's 23% in private assets, for example, but it's about 5/8 our reference portfolio that we're compared against in equities, and the balance between property credit and about a quarter in government bonds. Now, the government bond piece is a bit of a write-off, I think, as regards absolute return. It may do something akin to our liabilities, of course, we're a pension fund, but getting a absolute return of 5%, if you've got 40% of your portfolio, let's credit it with actually giving you 0, which might be generous, then you'd have 60% of your portfolio having to give you 5%, which 8 and whatever, 8 and a bit percent. So that is somewhat stretching. I mean, it stretches the equity risk premium to a degree that we haven't observed very much in history over long periods of time. So yeah, that does look challenging. And that's where perhaps if you find some infrastructure assets or private debt assets, you can perhaps take the weight off of the equity piece. But going to to a 100% equity portfolio doesn't seem a very palatable thing to do. So definitely it's important to look for diversifiers elsewhere. And we expect to boost our private asset exposure from presently 23 to about 29 or thereabouts over the next 18 months. Some of that is in the works already. But the thing about private assets is that we are being very selective, we think, and that means that it's not something where you turn the tap on. So the daily traded stuff, you can pretty much achieve the allocation that you want. But we've been going at this for a decade, and some years you make progress and some years you don't.
Given you've got long-dated liabilities which are relatively forecastable, the moves you make in your portfolio, do you perceive your portfolio today, let alone in 6 months' time, as riskier than it was 2 or 3 years ago, or as risky or less risky?
Well, that gets into the history of our organization. So I've been there just over 7 years. When I arrived, our asset allocation could have been described as 80% equities, 10% property, 10% government bonds. So we have certainly de-risked the portfolio over time. And the move into alternatives was quite an important piece of that. But we estimate that we've taken out about 20 to 25% of the risk in what was previously a very concentrated portfolio.
Excellent. We've gone through 22 minutes. So second segment, 30-second answers. Please no longer, or I will cut you off. Series of questions. Trump trades, overdone or more to go? Bob?
Overdone because people aren't differentiating enough. If he's got 6 major priorities, all 6 are not going to get accomplished at the same time and with the same intensity. So I think it's overdone because there's not enough differentiation among his policies.
20 seconds. Well done. Marino, Trump trades, overdone or more to go?
You can have my 10 seconds.
US Treasuries buy at 2 3/4. Have a look at real estate investment trusts in Europe, which has been devastated by the reflation trade. Emerging market, question mark. It really depends what the policy of the new administration is. And the S&P 500, well, increasingly uncomfortable.
Mark?
Trump trade, who knows? He hasn't done anything yet. So I can't tell you. I don't know what he's going to do.
But I guess then the 8% move between financials and utilities on the day he got elected would, based on that, be overdone.
You know what? Then I can say also underdone, right? If he really cuts down corporate taxes, if he spends a whole lot more money on infrastructure, if he managed to get half of the things he's talked about that are economic, forget about everything else, then, go along the S&P.
Roger?
Can I come back to the secular stagnation theme that we started with and say that, Trump hasn't done anything about global demographics. He's probably going to undermine the trading system to a degree. There's lots of negatives associated with Trump, but we will get a shot of adrenaline. So if I translate that into Bondo's sphere, where we've spoken quite a bit, this could be an inversion of the yield curve kind of world.
Next question. Should investors worry about inflation, deflation, or neither? Mark?
Depends where you are. Are you in Japan? In which case, I'm still worried about deflation. If I'm in the US, I'm not worried. I mean, I live in the US, right? I'm not worried about inflation, but it's something that we need to keep an eye out on.
Roger?
Well, I think the balance is tilted a little bit towards inflation and from deflation.
Bob?
We're a credit shop, so we worry about everything all the time, around the globe, nonstop. But I have to say, inflation and deflation, U.S., Europe, other major markets where we invest, neither one is at the very top of our worries. So if we have to be biased one way or the other, we'd probably bias a little bit toward more worries about inflation in the developed markets.
Marina?
If trade barriers goes up, you're going to have good prices going up because things are going to be manufactured in places which are not the optimal places where to manufacture these goods. So that is inflationary. But also, I'm convinced that after the next crisis, there's going to be an helicopter money policy all around the world. And at that time, we have to be very worried about inflation.
So it depends where you are, inflation, but maybe a bit further on. Top European risk in 2017, and is the market over or underestimating it? Marina?
Dutch elections. I don't think that in Germany or in France anything will happen, but in the Netherlands we might have a big negative surprise. So I'm going for a smaller country with a devastating impact. If you have a look at the euro currency, it should be higher given the trade balance that the Eurozone has, but it's not. So I think that is already incorporated in the currency. And from an equity point of view, well, I think the euro stock market has got a lot of potential, but it never expresses it. You know, we've been waiting for that for years now. So I think that some of those risks are already embedded in the pricing.
29 seconds. Perfect. Mark?
How about Italian banks? Right? There was something in the FT this morning at Monte dei Paschi. We've had a series of events with Ed Altman and talking about credit, and you're looking at a potential banking crisis in Europe. And I don't know how you fight that at this point. I mean, the economy is not particularly in great shape, and you got the ECB that's kind of run out. So what do you do?
Bob?
It's never fun to say that the markets are overestimating risk, so I'll have to say something that they're underestimating, I think. And I think a risk for Europe is actually higher energy prices. If higher energy prices really keep moving up, I think they could start to squeeze the consumer, and some of the areas of growth that you've started to see in Europe, it could start to impact their profitability and some of this recovery.
Roger?
I don't know whether this is a risk, but I think Europe is going to grow. I just don't know quite how they're going to generate the growth. But I mean, all of the political tension points to a growth-oriented policy, and the ECB is out of ammo.
You are so bullish for a pension manager. What's going on? I'm loving it. Top China risk, Roger. And again, is the market over or underestimating it?
Gosh, I could almost pass on this one. I think China's probably going to hold it together, and they've got a lot of controls in place. But I mean, the big risk is the adjustment from exporter to domestic consumption, and I think that Donald Trump has something to say about that as well. If it becomes a more abrupt adjustment, it becomes even more difficult.
Mark?
I'm in the same same view. I just don't. I think it is a big unknown. What will happen with debt? Can the central government keep everything in place? What will happen with Trump? So that's a bit of an unknown. But at the end of the day, if I think about China, they've got a very long-term view. They've got a unified, controlled government. They can do things that Europe can't.
Marina?
China risk has been forgotten. No one is talking about it anymore. I think it's coming back just every first week of each month. We've got the data on official reserves. I watch that number very closely. And if you start to experience 80, 100 billion outflows every month, even $3+ trillion will disappear very, very soon, very quickly. So watch that. They will keep it together if they can, but there will come a time of reckoning, and it can't last forever.
2017 issue?
I think probably 18. Next step is I think MSCI is reconsidering the inclusion of Chinese equities in global indices. So they held it together up to the SDR inclusion with the IMF. Now there is the MSCI. After that is job done, and they can just let it go.
Like everything else, we worry about China. And there's a lot of aspects to worry about China, and I agree. I think the market has kind of put it on the back burner. I'm going to sound a little bit like Ludwig von Mises, an Austrian school economist here for a second, but I think a big risk for China, and it's probably longer term, is it's a lot easier to control an export manufacturing economy than it is to control a consumption internal economy, because the consumption internally is run by individuals, and it's a lot harder to control individuals than large export companies. And I think that's a longer term risk for the transition that China's trying to achieve.
And that was a fantastic impersonation of an Austrian. Well done. So if I could summarize thus far, in Trump trades, not a huge amount of conviction whether there's more to go or otherwise, simply because we don't really know what Trump actually will be able to get through. On balance, more of a risk about inflation rather than deflation. It would have been interesting if we had this panel 6 months ago. Top European risk, probably the most diverse range of answers. We had both upside and downside risk. It's growth, it's oil prices going up, it's Italian banks, or it's Dutch elections. In terms of China, not really one for 2017. The market's forgotten about it, but it's probably a longer term issue around the move from export to consumption-led economy. Now pivoting a little, we talked a lot about private markets and the role in a portfolio. In this environment, hedge funds. Bob?
We're a credit shop. We don't have a hedge fund product. I would sell them all and move it into credit.
An unbiased response right there. Marino, you look across asset class. Would you be increasing, decreasing, or maintaining your weight in hedge funds?
Well, I don't think you should have much in hedge funds. You should only concentrate exposure in those strategies that you cannot execute otherwise, like, for instance, merger arb or things of that sort. But going with macro or quite standardized strategies that you can implement yourself, why should you do that?
Mark?
It's kind of the same view, right? If you get negative correlation, if you get something that you couldn't get otherwise, do it. Otherwise, 220, I don't know. I don't know if it makes sense.
Roger?
Yeah, well, we have a small hedge fund program. It was originally targeted, before I arrived at the organization, to become somewhat bigger as part of this diversification. And the program has done okay on its own terms. It's done badly against any other asset that we might have owned, unfortunately, because this has been a period that has lifted all boats, and this is absolute return, so it's been compared with sort of effectively cash plus. The proportion of the upside that is retained by the manager is egregious, and if you put a program of these together, then of course that proportion increases because you get 100% of the downside and whatever the 80% of the upside. So we've worked with the remaining managers. It's about a 3.5% of our fund to tailor the fee structures, longer term assessments, for example, that are less disadvantageous, but it's still it's under pressure for the charging.
One end of the fee spectrum to the other end of the fee spectrum, passive. If you can just go into passive allocations, why shouldn't you in the current constrained return environment? Marino?
Because static beta is going to deliver a return which is so low that you're not going to match your objectives. We think that any beta of public assets is going to get you not more than maybe 5.5% per annum in the next 10 years. And if you go and ask a state retirement scheme in the States, their return objective is 7.6. So it's not going to work.
Bob?
Passive strategies in credit have not been around that long. Really, of any size, they've really been around since 2010. There's a common theme here. There's been one trend, really, generally in credit since 2010. I think one of the biggest concerns in credit for a passive investment is they don't differentiate enough about what they own. And in the drawdowns that we've seen during this incredible rally, you can see it. You know, in 2011, when we had issues here in Europe and we had the downgrade in the United States, in 2013 when we had the taper tantrum, and then in 2015 we had this little shift in oil prices, they all dramatically underperformed during the drawdowns. And so you're really not getting the benefits of credit selection. And they really haven't gone through a full cycle, and when they've been down cycles, they've suffered a lot. So not surprisingly, I favor an activist strategy.
I'm sensing a trend, no hedge fund managers on the panel. It's bad, and no passive. Anyway, sorry, I digress. Mark, passive or active?
You're talking about the old core satellite. If you want exposure to U.S. large cap, passive, fantastic. You're trying to get U.S. Government bond exposure, passive, perfectly fine. If you're trying to really get credit exposure, you're trying to get emerging market, an emerging market passive fund, one versus the other, they're radically different. Do you know what you're actually really getting, right? And I don't think a lot of advisors or high net worth are really drilling into what they're really owning in the passive funds. So, I would have a balanced approach. For some, I think passive works extremely well. For others, I haven't seen active managers as excited as the last 6 months. They're all licking their chops saying, this is a market for us. We've been gotten killed the last 6, 7, 8 years because everything's gone one way. Now there's divergence, which means opportunity for them.
Roger, are you allocating more to passive, and also if you want to throw in factors?
Yeah, okay. So we're internally managing 56 billion pounds or whatever, and the cost of our active global equities is 5 basis points or something like that. So it's not that different from a passive fee, and that makes it relatively attractive, particularly as it has been a source of added value for us. The bit about factors, we do manufacture some factors. It's still a sort of small portion of our overall allocation to equities. We haven't wholeheartedly jumped on the bandwagon, but we do some of that.
Okay, I've got 4 questions left, then we'll turn it over in the 23 minutes we have. We talked about alternatives like private markets. We talked about alternatives like hedge funds, commodities. Mark, should we be increasing allocation to commodities broadly, decreasing, or maintaining in a diversified portfolio?
That's one I tell you I don't have a view. I've gone up and down, in and out. I've talked to different people. Right now this may be the active route, right? Because where do you go? So I don't have a strong view.
I'm going to ask a credit manager about commodities.
Well, indirectly we have a lot of commodity exposure in the credit markets because we have a lot of companies. A lot of them have been downgraded in the last year to below investment grade. Our number one job, the way we approach the business, is preservation of capital and trying to minimize your volatility. Commodities innately are highly volatile. So while we've gotten, not surprisingly, a bit more comfortable increasing our exposures to them, we still feel in a fixed income portfolio they're supposed to be underweighted if your goal is preservation of capital and return from interest income.
Marina?
Commodities, let's talk about oil. We think that probably a cap at about $60, $65 still exists because of production which might come out of the States, which is not going to stop. Technological improvements in extraction technologies will bring the price of extraction lower and lower. So I don't think there is a lot of scope for that. Gold. Is tough to see gold performing in a Fed tightening environment. And let's have a look at the currency market, the dollar versus other currencies. I mean, this is potentially a period where another period of strong dollar may be in front of us. And I'm not so sure that commodities will be very happy about that.
Third last question. Roger, best long-term investment theme, 5 to 10 years.
Well, I'll continue the optimism route and go with emerging markets. And I should have mentioned that if you're going to get these sort of higher levels of returns, then that's probably the engine that you're going to rely on. We've got some allocations, but if you look at Latin long-dated, inflation-linked bonds. I mean, these things actually pay a real yield, a substantial real yield. So you just have to hope and pray that they don't blow up.
Ever the optimist. Now let's go to our pessimist on the panel, Marina. 5 to 10 year investment theme.
If I could, I would capture the liquidity premium. And again, I say it again, private debt, asset-based investing, I'll do a lot of that. Again, unfortunately, not every investor is able to go into this illiquid type of investments. The second theme is obviously demographics, which is going to permeate a lot of what we do. And the third one is robotics. Mr. Trump might create some jobs in the next 2 to 3 years, if he's lucky, but those jobs are going to be taken away from automation and robotics over the next 10, 20 years, posing a real, policy dilemma, because when you have got 20, 30, 40% of the population without a job, then you have to come up with a solution. So I think these are themes and opportunities at the same time.
Bull and bear. Mark, best long-term theme.
I'll put my innovation hat back on, and I'll be a little bit positive for a second. And I think fintech, regtech, not the next 3 years. You're talking about blockchain and all these words that people like to bandy around. I think within the next 5 to 10 years, there's a good investment to be done there. Emerging markets does make sense to some degree. And I live in the U.S. I'll tell you the S&P 500 looks pretty good, if depending on how things go for the next 5+ years.
Mystic, Bob.
I think over the next 10 years, the markets are going to be a lot more dynamic and a lot more different. Over the last, we have people running trading desks, since '09 that have only seen one market, and I think we're going to see a lot more dynamism over the next couple of years. So I think one of the big themes is being able to capture the differences in where you're seeing growth and development in the U.S. versus the cycles that you're hitting in Europe versus the cycles you're hitting in Asia. And I think that differentiation is going to get greater and greater, and the timing is going to get greater and greater. So I think a significantly more dynamic investment approach is going to be one of the big themes over the next 10 years.
2 final questions, 20 seconds though, in interest of time. Mark, what is the top thing to avoid in 2017?
Market timing. I mean, really, right? So to Buz's point, you have a lot of divergence. You're going to have a lot more volatility, and the last thing you want to do is try to get in and out of the latest trend that you saw. So I would go with Marina's view of having some asset allocation and having some tweaks here and there is probably the thing to do. Avoid just listening to all the press and look at all that and just really have confidence in what you want to do and go.
Or panels of investment professionals. Awkward. Roger, top thing to avoid in 2017?
Well, 2. Overconfidence is the first one, and then I'll venture to unconfidently say, avoid income that doesn't actually pay you any income. I mean, what is this asset class? It used to be called fixed income. Now it's called fixed. What?
Cost. Marina?
Don't get too bullish on the S&P 500.
Very fair.
I would say I probably have to say U.S. investment grade debt. I think just because of the duration that it has and some of the challenges it has and where its concentrations are.
And then last question before opening up, top thing to buy in 2017? Bob?
I have to say we don't really look at things for 1-year plays per se. We tend to be longer term in investing. And since I have 10 seconds from before, I'll use it. I'd probably say I think there's two really interesting things for a longer term bet. I think one is when you think about displacement or liquidity, which can create value. I think some of the CLO debt, like a portfolio of collateralized loan obligations where you can get like a BBB average rating and 400 off U.S. Treasuries with very good structures now and very low default rates, I think are a really interesting place. And then the other thing I'll go on is that sort of dynamic theme. I do think some form of multi-asset accounts really can be very, very useful over the next year. But to Mark's point, I wouldn't have them unconstrained because if you're going everywhere and trying to get every trade, you're going to get into trouble. So I think a multi-asset approach, but with a constrained approach, I think is going to do very well over the next few years.
Marino, within your multi-asset approach, the single position you're most confident on in 2017?
Our largest position in our asset allocation portfolio is still US high yield. Although it is fully valued, I think from an information ratio point of view, is still the place where you can get some upside to participate in the US economy story. But obviously, you've got a great buffer of 7% coupon every single year.
Well, I was, there's one, I mentioned it earlier, I think syndicated loans are, high yield. I mean, from the U.S. standpoint, I think defaults are coming down. I was reading this morning, they're about 1.55% for the year. Recovery is reasonably high. You're expecting the economy to do, well, okay. So default rate's low. You get a nice coupon. You can get 300, 400, 600 bips over over LIBOR. It's not a bad place to be.
Last but not least, Roger.
Well, it's got to be something contrarian. So I'll go with Mexico. Mexican inflation-linked bonds. Maybe you want to go short UK inflation-linked bonds, pick up 5% real yield, and you could do something clever on the currency because both sterling is somewhat cheap, but the Mexican peso is certainly very cheap.
Heard it here first. Now third segment, I'd love to open up for questions. There's one at the back.
Hi, my name is Anna. I'm with a family office in Hong Kong, and we are big impact investors, so that's the caveat. In this environment where I realize we're talking about risk and returns purely financial, but is there, in this environment, is there more of an opportunity for impact investing, and what are the challenges for that?
There probably is, and I think it's going to be interesting given some of the U.S. President-elect's policies or stated policies, the actual policies are, but if managers are actually going to take more of a role of whether it's on the ESG front, which we've been very involved in, or direct impact investing, I think some of his statements and comments may inspire more of that. From a purely economic point of view, impact investing in ESG you can't ignore, because if these type of factors are going to I'm just using this as an example, going to prevent everybody from investing in coal, and these guys need to recapitalize, it's going to hurt that sector. So whether you care to follow ESG rules in impact investing or not, you have to be aware of the impact that they can have.
Yeah, I mean, maybe to that, looking at the wealth management clients, there's definitely an increase in interest. I think partly it's a lower return environment. So the relative returns, even if one is expecting below market returns slightly, that difference is less relevant. I think secondly, the huge increase that we've seen within intra-country income inequality and the populist movements are actually refocusing people who've done pretty well out of the economic trends and the stimulus since 2008, 2009 on how to actually mitigate the risk that this populism is posing for their current positions. And I think thirdly, linked a little bit to going up the risk curve, the fact that people are increasingly looking at private market and private debt kind of models, it's not a tough step to then move one step further and look at something which is impactful in that space. So all of those dynamics, and to maybe quantify it, the largest impact investment we'd ever raised at UBS against $2 trillion of assets was $35 million up until March this year when we raised a $500 million oncology fund. That wouldn't have happened 3 years ago. Sorry, question? So the question is, where are we in the credit cycle? How much further to go until the next crisis? And then what will spurt the next credit cycle? A credit expert.
There's so many great credit cycle analogies. We could use a clock in America. We could use baseball innings. We could use extra time in a football match. I think it's extremely hard to quantify when the credit cycle is winding down. For example, in the U.S., we've seen such activity in the leveraged loan market and so much bank loan activity now. it certainly looks like the credit cycle is going to be extended out further. I think the other thing is we're not seeing necessarily leverage rates, the amount of leverage increasing in the type of lending activity. We're not seeing a real bubble occurring somewhere, which usually happens when a credit cycle comes down. And quite frankly, most in the developed markets, in most areas, we're seeing slightly better growth and anticipating slightly better growth, which also doesn't lend itself to a credit cycle blowing up. And maybe we think about credit cycles wrong. Everything else in the world is moving so much faster, but we still think about credit cycles in these long cycles. Maybe 2011 was a credit cycle. Maybe 2013, that was 4 months in the U.S. was a credit cycle. You certainly, during those times, you saw debt issuance pull back dramatically. So maybe the credit cycles are just happening quicker.
Yeah, I would say from the data that we've seen, that some indicators tell you you're in that overtime, extra time. Some tell you you're perfectly fine. From again, the series of events we hosted with Professor Altman the last few weeks, the one theme that keeps on coming out is what shock could happen to mess this up, right? If nothing happens, who knows? But then you have China and you have Europe and you have, we haven't talked about geopolitical risk. There's North Korea, there's Iran, there's Saudi Arabia. You can just go on and get really pessimistic, which should make you really happy. Right? So we just don't know.
Sorry, question in the front.
Yep. Wanted your views on emerging markets. We had some fleeting references during the discussion, and across the three asset classes, fixed income, equities, and private markets in emerging markets.
Marina?
Well, I think in emerging market, there are a couple of things that we have to look at. The first one is the dollar. We know that there has been a lot of borrowing, which is classic emerging market borrowing, which is dollar denominated. So in a world where the Fed tightens and makes this debt more expensive for emerging market borrowers, and the dollar goes up, which makes it more expensive to buy back the dollar to pay back the loan, this is going to be a total disaster. It doesn't apply to all the countries and all the companies in emerging markets, but you may expect a lot of volatility if the Fed continues to hike and if the dollar continues to go up. So that is the issue at the moment. After many, many years of underperformance of emerging market asset classes, we're finally getting there. The first 9 months of 2016 have been very good. Finally, emerging markets have been outperforming again. But now the selection throws a dark cloud over the asset class. And to be honest, we are uncertain about how this will pan out.
Roger?
Yeah, at least you are paid a risk premium for a reason. So there's clearly is a risk. But I've mentioned the emerging market, local currency, perhaps particularly debt. But we have a private investment program. It's not been very venturesome in emerging markets as far as the private markets are concerned. We have some toll roads or things like that, which are perhaps at the low risk end of the spectrum. So I can't really speak to that piece. And then the emerging market equities have been the dog of the last several years, with a brief rebound that got trumped, but may well continue.
I guess at UBS, we're kind of the other end of the spectrum from Marina. We're overweight EM equities, overweight a basket of high-yielding emerging market FX, and then we're less positive on the debt, and part of that's positioning. The underperformance in EM has just let most multi-asset managers incredibly light on EM equities. At the same time, EM debt has been hoovered up. So that, I guess, would be our relative preference. Earnings are finally improving. The economic growth is finally improving. It's been a false dawn for 4 or 5 years, but now we're actually seeing it in the numbers. Please.
Could you talk a little bit about liquidity conditions across the publicly listed credit markets? And I'm thinking particularly in light of the reduced role of investment banks within the market, and during those periods of drawdown, how the different asset classes or how the different areas within the asset class have managed in terms of liquidity?
Yeah, we spent a lot of time looking at liquidity in the debt markets, obviously, and worrying about it. And I think, liquidity really has two components. How much can you trade and what the price is? And I think, to some extent, surprisingly, liquidity has been very, very good in the credit markets. And actually, during some of the periods of drawdown, like that last week of September last year, which was one of the worst weeks in the credit markets, had some of the highest volumes ever. You may not have been happy with the prices you were getting done, but it worked. The markets were working the way they were clearing, and it was some of the highest volume. And it's really interesting, and I'm going to sound like an Austrian again here, about markets clearing.
It is uncanny. How else can you sound?
When you think about it, when the investment banks got pulled out of really using their balance sheets, you saw volume as a percentage of the the total market really drop around 2011, and it really got lower. And since then, the percentage of the market that's been trading every day has increased fairly steadily. And I think a couple of things have happened. The markets have adjusted. They've learned how to act without this extra balance sheet there. And also, they've become more diversified. You have more diversified investors coming into the market, so everybody's not moving in and out at the same time. The markets have grown in size, so there's more diverse industries and more diverse type of companies. And I think that's helped the liquidity, too. It's still a semi-liquid asset class to a large extent, but the liquidity has actually gotten better from all the measures we can see.
Well, I think that the market, I'll take that point on market diversity, right? It used to be there were X number of institutions that you had to call if you ever wanted to trade. Well, maybe there are fewer of those, and they may do other things, but there are other avenues where you can get liquidity. I haven't found one investor the last, call it a year or two, that said when they wanted to do a trade, they just could not find the opposite side of that trade. If you want a bond, you can't find that bond. That's not bad, right? The question is, I'll leave that out there, which is when the ECB buys 40% of the debt, it's also easy to find somebody who buys the debt. Question is, okay, the day they have to start selling, or then the question becomes what happens to that liquidity. But so far, from just plain statistics, numbers, it doesn't look as bad as anybody makes it out to be.
I think we have time for one final question at the back.
Robert Drakowski, BOC Pensions. There weren't any comments on the asset class we define as infrastructure, particularly with the Trump presidency upcoming. What are your thoughts, sort of U.S. and global?
Roger?
Well, infrastructure is, in theory, a very desirable asset for those who don't need liquidity, and they do need inflation-linked long-term income streams. The challenges have always been in the packaging and the contract structures, the regulatory environment. I guess there's not a huge amount that is clear today about how the US infrastructure development program will roll out. It sounds like it's going to be very big. Why not call it $1 trillion? Because that's tremendous, great. So it's going to be a big one. As far as UK pension funds are concerned, the US has been making itself more accessible to us from a tax treatment perspective as well. So we could well be looking at US infrastructure. We own a port in Virginia. In fact, we're 68% of a port in Virginia. So we have made some inroads there, but it's a huge potential opportunity.
Excellent. Unfortunately, we've run short of time. So please join me in thanking our panel. Roger, thank you very much. Mark, thank you very much. Marina, thank you. Bob.